How would you know if your retirement plan has a hidden leak before it gets expensive? Hi, I'm Matt Goolsby, and for years we've watched good, diligent retirees do all the right things, but yet still lose money to the gaps between the professionals and retirement. The space where the investments, taxes, Medicare, and estate planning are supposed to connect, but oftentimes don't. In the next few minutes, you'll discover number one, the coordination gap, why separate advisors can unintentionally work against each other. Number two, the adjustable rate retirement account, how your IRAs and 401ks, they behave like adjustable rate loans you don't control, and what to do before the 2026 rate changes. Number three, the Medicare premium trap, or IRMA, how $1 too much of income can spike premiums 2 years later. So if you're within 5 to 10 years of retirement or already retired, and you've saved between 750,000 and 3 million, you're in the right place. So if you're looking for a stock tip or a quick trade, this is not that. But if you want one coordinated plan and one team to remove the burden from your shoulders, you're going to love this. So oftentimes, the damage in retirement doesn't happen inside an investment, a tax return, a Medicare plan, or even your trust. It happens between them. So here's what that looks like in real life. Take Paul and Terry, for example. They came in when Paul's boss had accelerated his retirement date. Their investment withdrawals, they looked fine in isolation, but no one had modeled for them how those withdrawals would interact with the deferred compensation, the RMD timing, and their Medicare. The result was a pending IRMA surprise and a bracket creep that we caught before it hit. We coordinated the plan across all 4 areas and removed thousands in future surcharges and taxes they didn't need to pay. Let me tell you about Sharon. She lost her husband. He'd done everything right, or so he thought. He had a trust, the will, the powers of attorney, great legal work, but several accounts still pointed to old beneficiaries. Because documents and accounts weren't coordinated, assets would have bypassed the trust and triggered taxes and fees that weren't intended. So we retitled, updated beneficiaries, and mapped the flow of assets so her plan finally matched her documents. One more story here with Bob, a senior manufacturing executive. He suddenly lost his wife, and she was the money person at home. He was a brilliant leader. He'd done well saving for retirement, over $2 million. But suddenly, when he lost his spouse, he was vulnerable. We built a spousal Social Security blueprint, who to call, where everything lives, bill paying steps, and how decisions get made so he's never alone in a crisis. Here's the theme. You shouldn't have to be the middleman. With one coordinated team, decisions get reviewed before you pull the trigger. So if you're already seeing a few gaps in your plan and want to make a quick gut check, I have a limited number of 15-minute intro calls where we have a conversation. There's no pressure, just clarity. Click the button below and grab a time now while I continue the training. Imagine a 30-year mortgage whose rate can change anytime Congress holds the dial. See, that's your traditional IRA or 401k. You haven't saved all of that balance. You've saved what's left after future tax rates. So why does this matter now? Well, we're in a relatively low rate environment, and scheduled changes that will probably arrive in the year 2029. So these required minimum distributions later can force you into income you don't need, pushing you into higher tax brackets, taxing more of your Social Security and possibly triggering the Medicare premium trap, aka IRMA. Now, Robert and Edith's plan, they have high IRA balances, modest taxable savings, and we modeled their lifetime taxes 3 ways and created a multi-year Roth conversion plan that stays inside target brackets and below key IRMA cliffs. It reduced the future RMDs and gave them more control over survivor taxes for his wife, Edith. Now, Steve and Judy. Steve's an engineer we had met, and he had spent a lifetime doing what most engineers do best: planning, saving, and being disciplined. By the time he'd retired, he and his wife had nearly $2 million set aside. Now, what he didn't realize was that without coordinated tax guidance, every withdrawal decision was quietly working against them. See, each year they'd paid more in taxes and Medicare premiums than necessary. And it's not because of bad investments, but because no one was looking at the full picture. By intentionally sequencing income, timing Roth conversions, and planning around the Medicare look-back, along with coordinating charitable giving, we helped them stop unnecessary bleed without changing how their money was invested. So the key takeaway here is get control of your tax-exposed balances before those future RMDs do it for you. You can right-size with conversions and coordinate with Medicare and estate planning goals. The next piece, it might be the most overlooked and the fastest way to lose thousands, essentially for no extra benefit. When we started integrating tax planning with Medicare 2 years ahead, it changed client outcomes dramatically. I'll share with you exactly why, and then I'll invite you to see it for yourself. Because here's the reality. Retirement isn't a dress rehearsal. If your plan has silent leaks, they can compound. So let me ask, when a spouse passes away, when your RMDs start, when a one-time stock or investment sale hits your tax return, what's your playbook? You don't rise to the level of your intentions, you fall to the level of your systems. And if you're ready to put a coordinated system around your money and your healthcare costs, we want to help. Click the button to book your Step 1 15-minute intro call. Now onto the Medicare premium trap, or also known as IRMA. Medicare premiums aren't a one price for everyone. They scale with your modified adjusted gross income, and they're based on what that income was 2 years ago. If you cross an IRMA threshold by just 1 penny, and you can owe hundreds to thousands more for the entire year. And that's a cliff, not a slope. Let me tell you about Camilla. She turned 65 and enrolled in Medicare. 2 years prior to that, she'd completed a large Roth conversion without anyone modeling the Medicare impact. The result? Higher premiums she didn't anticipate. We appealed what we could and then rebuilt her plan to smooth out income, coordinate future conversions, and of course use QCDs to meet charitable goals without raising the MAGI. And that's the coordination most people don't have. Paul and Terry, again, their accelerated retirement required us to stage income so 24 months later, they wouldn't slam into a higher bracket and IRMA at the same time. So what should you do? Well, you need to project 2 years ahead and coordinate conversions with thresholds, use the right buckets in the right year, and of course, make sure your advisor, CPA, health insurance specialist, and estate planning attorney are all working from the same plan. You've seen how uncoordinated plans can quietly leak money and how a Core 4 approach helps restore control. If you want this level of clarity for your own numbers, let's chat for 15 minutes by phone. Click the button to book your Step 1 15-minute intro call, and we'll show you exactly where the gaps are and how you can close them.